Hello learners, in our previous video we learn about what is accounting, what are the objectives of accounting, what are the needs and branches of accounting. In this video we are going to learn advantages of accounting, its limitation, what is accountancy and accounting concept conventions. So let's get started. What is the advantages of accounting? Advantages of accounting means when we maintain proper record of our business transaction, then it prevent fraud. Then we collect debt from our data. Comparison is easy, whether the physical stock is available or not. We can compare this much quantity we are putting in the book of account. Is this is true in the physical stock? Then ascertainment of profit and loss and financial position. From profit and loss account we know the net profit of the firm and financial position of the firm, where the position of assets liabilities takes place. Then proper recording, these are the advantages. Then next is limitations of accounting, having alternate. It is a limitation because if one firm following LIFO method for inventory control, then another company following FIFO method for inventory, also another company following average price method, then it is difficult to find out or compare between two companies balance sheet or two companies inventory management. Then ignore importance of non-monetary information, which means the loyalty and efficiency of the employees may not be shown to the management. Doesn't provide detailed information regarding cost, revenue, profit of each product. Then doesn't disclose the present value because in our balance sheet we in our financial accounting we take the historical cost, so it doesn't close the present value. Then manipulation of accounting data, when account only the accountant maintain the accounting record, then it is easy for manipulating by the accountant. So for this also there is a solution, but it is not possible for the smaller organization, that is auditing. Then what is accountancy? Accountancy means the guidelines, rules, regulations which we are follow for the accounting. For example, GAAP, Generally Accepted Accounting Principles, IFRS, International Financial Reporting Standard, Ind AS, which follow in India. So basic difference between accounting and accountancy means accounting is the art of recording the business transaction, and accountancy means the method or the procedure we are taken for the accounting, that is accountancy. Then who are the users of accounting? There are two types of users. Internal users, who are the management, like top level management, middle level management, lower level management, owners who are the shareholders, managers. And then external users are who are directly associated with our company, or others are indirectly associated with our company. The who are directly associated, those are creditors, investors, employees, tax authorities, consumers, foreign entrepreneur, or those who are indirectly regulatory body, republic, researchers. These are the indirect users. Now the question arises, what are the qualitative characteristics of accounting? Means what is the quality of accounting which may must be followed? First is reliability. Reliability, as the name suggests, real. Like this, the data, the business data must be faithful. Presentation of information must be faithful. Then neutrality. Neutrality means it must be free from bias. Then prudence. Concept of prudence means record all the expected losses but not the profit. Then verifiability, verifiable cash memo or physical stock. Then completeness, the data must be completed. Then substance over form based on financial reality. Then the second one is relevance. Helps in decision making. To whom it helps? The internal users and the external users. Understandability. Understandability means it may understand by all the users. For example, if he is a commercial student or he may not be a commercial student, it should be understandable by all. Then comparability. Comparability means we can compare our financial statement, income statement with intra-firm comparison or by interfirm comparison. Then next is accounting principle. Accounting principle means the guidelines, the rules, the standards, the assumptions, conventions which we follow to which we follow to harmonization or to make financial statement more meaningful. When all the firms in the world or all the company, when they follow the same standards. Let's take example of INDES. I- According to INDES, in India, all the company which are exist, it must be follow INDES, which means it should be easy. Sorry, it will be easy to compare between firms of Indian companies. Then assumptions of accounting. The first one is going concern concept, which means the persons of the company may goes or come, but the business will be run for a long period of time, whether the owners or the shareholder are a part of company or not. Then consistency. Consistency means the firm or a company have to follow a method for a consistent period. For example, if a company following LIFO method or weighted average method, then it consistently follow this method for a long year. Then accrual concept. Accrual concept means when the transactions are made or occur, make entry at that moment, whether the cash is received or not. Next one is business entity concept. In this concept, business and the owners are separate, which means the owner invested fund in business and the business as we know, business is an artificial person. Then business have to pay. Uh, it is a liability for the business, so business has to pay that much amount to the shareholder or the owner with dividend or interest. Then money measurement concept means everything will be measured in monetary terms. Accounting period concept means every year we record the transactions. Then cost price, as we all know, assets are recorded in their cost price, in which rate we are acquired them. Then dual aspect concept. Dual aspect concept means every transaction has its own debit balance or also corresponding credit balance. Then revenue recognition concept. Record the revenue or sale when goods are transferred, not when payment is made. That is revenue recognition concept. When the sale is made, you think that your revenue is made, whether the payment is received or not. Then matching concept. Match your expense with the revenue so that you know the profit and loss. Thank you.